At present, a phenomenon is unfolding across the bullion sector which practically nobody grasps accurately. Over the past 30 days, 11 billion exited precious funds via one massive surge. Ankara offloaded 60 tons of reserves in 2 weeks. Middle Eastern state portfolios keep draining tangible metal from the British depositories, matching a velocity unseen for 7 full decades. Yet gold, an instrument which is designed to spike higher amidst a conflict, plummeted 21% below its winter high. Each major network keeps posing the incorrect inquiry. Broadcasters keep wondering why the yellow metal drops during wartime. I prefer to pose an alternate query. I choose to explore what this will spawn. Since my 4 decades of tracking exchanges alongside credit loops, I finally grasped how the most critical financial shifts across time rarely seem like openings as they unfold. They resemble absolute disasters. But currently, hidden beneath the turmoil, 3 distinctly isolated capital gateways stand unlocking at this exact moment. I have never witnessed such confluence since 1979. Listen to me. I shall now reveal exactly what I perceive here. This is the concept I intend to clarify for you over these upcoming moments. Initially, I hope to demonstrate exactly how bullion's plunge is hardly what it seems on surface, while explaining the machinery driving this stands arguably the most positive indicator I have spotted for ages. Next, I aim to unveil clearly an industry which practically zero pragmatic traders are discussing much right today, yet wherein corporate capital sits shifting through a method that echoes one among the most dependable power trends across the past 50 years. And thirdly, I wish to display here what I trust remains the most fundamentally foreseeable capital handover throughout the timeline of the medical business, plus why the timer concerning this stands actively counting. These remain factual realities. These embody progressions. Furthermore, comprehending progressions remains exactly isolating traders who generate lasting riches away from people reacting toward news. Please let me explain what truly sits unfolding across bullion. When exchanges confront a concurrent petroleum disruption alongside an aggressive monetary authority reaction, something uniquely precise materializes. Borrowed portfolios, those entities operating intricate, diversified tactics, become trapped. They sit heavy petroleum, lacking stability. When crude surges above $110 a barrel while the National Reserve indicates it refuses dropping yields due to inflation, these vehicles suffer margin requests. Plus, when you suffer a margin request, you liquidate your top-performing holding immediately. Bullion had climbed 65% over the 12 months preceding this liquidation. It remained the most lucrative trade across numerous corporate ledgers. Therefore, they dumped it. Not since they ceased trusting in it, simply they needed to. The metrics validate this. BNP Paribas resource analysts state that during 2008, 2020, plus 2022, those 3 preceding massive financial disruption periods, bullion originally dropped because traders dumped their top-yielding holdings to generate liquidity. Throughout all 3 scenarios, metals subsequently rebounded while reaching fresh peaks after the forced liquidation became depleted. This remains what I need you to comprehend. $1 billion exited bullion ETFs during March 2026. This means no retail traders liquidating. This means corporations covering margin requirements. The fundamental motive to hold metal, de-dollarization, budgetary shortfalls, reserve authority broadening, remains totally unchanged. What shifted remains the chart layout. The valuation dropped lower due to who sat liquidating rather than due to why metal breathes. JP Morgan just sustained their late year 2026 metal forecast near $6,300. Deutsche Bank sits near $6,000. Neither institution has shifted these forecasts. This disparity connecting $4,300 currently alongside $6,300 remains hardly some prophecy. It forms a theory regarding what occurs once the forced dumping concludes. I have sat analyzing credit rotations alongside international shifts across 40 years, and whenever I gaze toward what keeps unfolding today, I detect a trend which pops up without failing near massive turning faces. The trend remains this: Periods carrying supreme chaos generate the broadest chasm dividing cost from worth. Right today, this chasm breathes across 3 isolated zones. Plus, the traders who grasp the machinery rather than the newsflash shall sit prepared before the herd jumps aboard. Please let me walk you through each sector. Yet beforehand, should you deem this style of macro-tier assessment helpful, register today. Register today.
Let me sound exact regarding what forced liquidation involves, since numerous folks repeat the idiom lacking comprehension about mechanics. Whenever a private fund operates a borrowed strategy, let us assume they sit 3-to-1 geared while the worth of their ledger falls by 33%. They become bankrupt. The dealer rings. They must generate funds instantly. They do not wonder what seems affordable. They wonder, what can I dump rapidly? The reply remains forever their highly fluid, highly lucrative holding. During March 2026, that holding meant bullion. Ankara offers a prime example regarding how panic capital appears seen across the state tier. The Anatolian lira struck its 11th successive historic bottom versus the greenback during the 16 market sessions, trailing the explosion of the Persian skirmish. The Reserve Authority of Ankara retains above 111 tons of metal inside the vault of Britain. Reuters noted they sit weighing lending against this metal to protect the lira. In the interim, they dumped roughly 60 tons into the exchange. Mumbai turned a clear dumper. Middle Eastern state portfolios, ADIA, PIF, peers whose moves stay never revealed openly, popped up across the British Metal Exchange metrics, showing a 45-ton drain beyond the standard mean. This remains what I need you to scribble down. These groups did not cease trusting regarding metal. They required greenbacks, panic greenbacks, to settle for crude, which currently runs 40% higher than it cost 60 days past. They sit dumping heritage assets to settle a fleeting invoice. Plus, this remains the machinery which trails predictably across each rotation I have analyzed. Once the panic has passed, once crude stabilizes, once forex stress fades, these identical players rotate inward. They do not return back softly, they return back aggressively, since their treasury broadening directive demands this. The Global Metal Board predicts reserve authorities shall purchase roughly 850 tons of metal during 2026, practically matching to last annum's speed. The purchasers did not vanish, the dumpers remained fleeting. Meanwhile, silver shares a distinct narrative, plus across certain angles a highly compelling tale. Silver holds dual usage drivers which bullion simply lacks totally: financial appetite plus manufacturing appetite. During 2026, silver sits currently inside its 5th successive cycle, showing commercial inventory shortage. Photovoltaic arrays, battery cars, AI server hub architecture. Every single one remains an inflexible purchaser regarding silver.
They do not fret over cost. They require the element to construct the hardware which the worldwide system demands. Yet still, silver sits exchanging far beneath where manufacturing usage basics indicate it must rest. This void dividing synthetic silver, forward agreements, fund units, assigned ledgers, against tangible metal remains arguably one among the signature systemic anomalies characterizing the previous 10-year period. I have observed it swell. At some stage the void seals. It forever does. Once it acts, it seals rapidly. The fundamental upside for dual elements has not shifted. What shifted remains the cost, whereas cost during the brief term stays dictated via the highly frantic liquidator inside the chamber. Right today, the highly frantic liquidators stand unloading. This gateway will not remain unlocked forever. This remains the segment regarding the breakdown which shocks numerous folks while I grasp why. Carbon remains barely a term linked toward upside. Over the prior 10-year phase, it stayed linked toward decay, ecological directives, green limitations, retirement portfolio divestments. Corporate wealth has methodically shunned it. Carbon-digging firms have sat deprived regarding capital. Yet this remains exactly why it proves compelling toward myself. Next, please allow myself detailing the machinery. Whenever Brent raw petroleum exchanges beyond $100 a barrel, This alters the math surrounding each substitute power well across Earth. Grid operators do not execute philosophical choices. They execute mathematical choices. Plus, whenever methane vapor costs surge since LNG delivery routes sit broken exactly as they run today, alongside Doha fuel having triggered emergency clauses covering extended agreements trailing strikes upon the Ras Laffan site, operators begin hunting toward the cheapest open alternative. That alternative is coal. Across Europe, it runs presently cheaper to operate carbon-fueled power stations versus vapor-fueled stations. This remains hardly some ideological claim. This forms a cost correlation. Continental operators keep replenishing carbon stockpiles toward a heating period which could stretch longer, plus chillier versus projections indicated 3 months prior. Across India, the metrics sit vastly more systemic. Power Metrics India 2026 released via the Federal Department regarding metrics reveals carbon feeding almost 79% concerning internal power, although while photovoltaic plus breeze infrastructure grows aggressively. Delhi's carbon mining breached past 1 billion tons during budget cycle 2024 to 25. Carbon usage sits forecast to expand roughly 2.5% during 2026. Delhi's petroleum foreign reliance hovers near roughly 89%, which guarantees each petroleum cost spike creates a crisis affecting Indian power strategists. Their reaction dependably remains to optimize internal carbon yield. Plus, across the American Republic, the sitting cabinet approved a presidential decree this April to stimulate internal carbon digging, featuring ecological rule exemptions covering running carbon stations. The impact remains a bullish adjustment across American carbon appetite projections through 2026. This remains how the capital landscape appears today. One 10-year period of green dumping has crushed investment spending across carbon digging worldwide. Inventory has collapsed. Today, appetite stands climbing, not since the globe shifted its morals, rather since the globe shifted its power costs. This pairing, choked inventory colliding against climbing usage, forms the environment which spawns the most violent resource swings. I stand hardly proposing this means some 50-year play. I stand arguing this represents a rotation. This rotation stood forged via investment starvation. It shall stand cured via investment inflow. Plus, connecting these dual extremes, there exists a play. Smelting carbon, the industrial carbon leverage during alloy forging, holds a distinct usage catalyst which I deem similarly fascinating. Every massive military budget spike throughout recent eras has demanded alloy. Vessels, armor, ballistic networks, barricades. The USA, Europe, alongside their partners, sit fully dedicating toward extended military budget surges starting today. Smelting carbon targets from global lenders forecast a valuation band around $215 toward $222 a unit across 2026 plus 2027. You cannot construct a vessel lacking alloy. You cannot forge alloy lacking smelting carbon. This procurement web remains barely flexible. The corporate capital sits currently rotating. Carbon India, the nationalized corporation which remains one among the globe's biggest miners, sits climbing 11.3% annually currently through 2026, whereas the wider Nifty 50 tracker sits dropping 6%. This decoupling means zero static. This means wealth shifting toward an industry which numerous traders stood warned to shun. I have witnessed this style of environment previously. During 1999, software remained the crowded momentum play. Power remained the crowded black hole. By 2005, power had crushed software through a massive leap. The machinery seems hardly identical currently, yet the architecture echoes. Crowded starvation generates inventory shortages. Inventory shortages generate valuation surges. Valuation surges generate returns toward players who deployed early. This final gateway remains the avenue I deem highly fundamentally foreseeable. Plus, via foreseeable, I imply something exact. I imply how the triggers pushing this sit currently timetabled. The deadlines stand publicized. The income figures sit revealed inside yearly filings. This remains the backdrop. The worldwide medical sector confronts the death of exclusivity shielding surrounding roughly $300 billion of yearly therapy income entering 2030. This remains barely guesswork. This forms a roster of therapeutics carrying publicized death dates. Keytruda Merck's oncology breakthrough birthed $29.5 billion during 2024 while sitting forecast to crest near $32 billion during 2026. Its central shield dies during 2028. Once an antibody sheds exclusivity shielding while generic rivalry strikes, income might plunge 80%. Eloquist, the circulation med jointly sold via Bristol-Myers Squibb alongside Pfizer, sheds American exclusivity shielding during 2028. This birthed $13.3 billion of joint turnover. BMS confronts the sharpest relative plunge among any massive medical conglomerate, showing 47% of their turnover under threat entering 2030. Ompic alongside WGOI Novo Nordisk's semaglutide division birthed a joint $26 billion during 2024. Foreign shields die across Canada, India, Brazil, plus Beijing during 2026. These conglomerates realize this, their directors realize this, their corporate advisors realize this. Plus they hold one core reaction: purchase. Medical corporations cannot construct some fresh mega-hit therapy within 2 cycles. In-house creation demands 10 toward 15 cycles on median while demanding roughly $2.2 billion per compound. They do not possess that runway. Thus they purchase what lives. Stifel Brokers calculates the joint buyout capacity across massive medical corporations near $1.2 trillion. Overall medical buyout transaction size hit $240 billion during 2025, an 81% annual growth rate jump. Across the initial 2 weeks of January 2026 uniquely, $9.2 billion of transactions stood publicized. Lu Advisory forecasts greater than 20 buyouts exceeding $1 billion during 2026 purely. This remains the capital machinery I need you to grasp. Giant medical conglomerates stand hunting toward tiny bioscience entities holding lucrative therapy molecules during progression. Whenever they locate one plus absorb it, they usually shell out a massive bonus beyond the exchange valuation. 30, 50, occasionally 100% beyond wherever the equity sat exchanging. Should you sit deployed inside the optimal bioscience entity prior this takeover occurs, you harvest this bonus. The inquiry remains hardly if this shall occur. The takeovers stand currently sitting publicized. The inquiry remains if you grasp the trend solidly enough to deploy in anticipation. I hope to sound transparent regarding the danger metrics. Bioscience harbors a massive collapse ratio. Laboratory testings collapse. Regulator greenlights sit stalled. Singular startups might plummet toward zero. This remains hardly an arena toward localized gambles. The fitting allocation, if present, sits spread. Wide-spanning bioscience trackers like XBI or IBB that grant you exposure toward multitudes of startups concurrently, or the massive merged medical conglomerates who stand currently steering the expiration cliff via buyouts plus tweaks. What I deem highly critical regarding this instant remains the confluence of catalysts hitting concurrently. This expiration cliff births a shopper holding a $1.20 $2 trillion ledger plus a timer. Machine learning therapy mapping remains shrinking creation runways. What formerly demanded a cycle might currently consume 3 cycles. Plus the bioscience space itself, having trough dived during springtime 2025, has rebounded 75% while sits currently offering the pricing climate wherein dumpers plus shoppers might align regarding cost. This capital migration away from massive medical ledger books toward bioscience equity holders sits currently in gear. This velocity sits timetabled. The deadlines sit within the yearly statements. Please let myself merge these 3 gateways together plus explain to you what I genuinely trust. This bullion plus silver dump represents a panic dumping occurrence, hardly a systemic shift. The systemic purchasers, reserve authorities, patient capital, de-dollarization adopters remain deeply active. The valuation has decoupled away from worth. This gap shall seal. It has sealed across each previous rotation. This power pivot toward carbon represents a symptom of inventory crushing colliding usage rebound. It represents hardly a lasting unwinding regarding the power pivot. It remains a rotation inside a movement. Plus rotations correctly grasped yield profits. This bioscience expiration cliff remains the highly systemically automatic opening I have spotted across any space over a cycle. This appetite toward buyouts sits measured. This roster of shoppers sits pinpointed. This schedule stands publicized. This single unknown remains which exact startups become purchased near which valuation. What links all three remains a theory I have circled back towards spanning my profession. The disparity separating cost against worth. Cost remains what the exchange dictates exactly today during this instant amidst these parameters. Panicked liquidators, terror, margin requests, crude spikes. Worth means what an item sits valued whenever the parameters stabilize. This chasm separating cost against worth remains where capital sits birthed. It feels hardly soothing. It rarely feels. These instances whenever cost alongside worth sit highly divorced remain forever the instances which appear highly hazardous. During 1979, bullion dropped violently while the national bank beneath Volcker hiked yields fiercely to combat pricing pushed via and crude shock. Numerous traders dumped. People who maintained or purchased watched metal surge above 200% across the subsequent 3 cycles. I sit hardly forecasting an exact destiny. I sit spotting an exact machinery. Whenever you grasp the machinery, you do not require to forecast the destiny. You must to grasp the progression. Plus right today the progression means panic, dumping, depletion, systemic purchaser bounce, valuation rebounds nearing worth. These 3 gateways I outlined today stand unlocked. They shall not stay unlocked forever. Those traders who comprehend what sits fueling them, rather than the news, rather the machinery, remain the folks who deploy prior the herd jumps aboard. Please let me conclude regarding how the metrics rest presently. Bullion exchanging near roughly $4,300, sinking 21% below winter's $5,596 crest. JP Morgan late cycle forecast, $6,300. Deutsche Bank late cycle forecast $6,000. This suggests 46 towards 67% climb beyond present tiers, presuming the systemic theory stays. Silver 5th successive cycle regarding commercial inventory shortage. Syntheticto tangible correlation stretched. Valuation bounce traditionally trails bullion's bounce carrying expanded intensity. Carbon India carbon climbing 11.3% annually currently versus and fading wider exchange. Smelting carbon valuation target $215–222 a unit entering 2027. Military alloy appetite systemic plus extended bioscience $1.2 trillion of medical buyout capacity 20 extra takeovers exceeding $1 billion forecast during 2026. $300 billion of exclusivity threatened turnover entering 2030. The timer regarding this capital migration sits ticking. These represent hardly endorsements. These remain metric nodes. How you act upon these relies upon your personal fiscal reality, your investment runway, your danger appetite, plus your discretion. Yet the metrics remain exactly what they show. I wish to exit here dropping one ultimate concept. Throughout each massive rotation I have analyzed, there exist dual breeds regarding traders near the turning node. This initial breed watches toward the valuation dropping while deduces the theory stands shifted. They dump or they remain sidelined. They pause toward absolute clarity prior deploying. When that exact clarity lands, the valuation has permanently shifted. This alternate breed poses an alternate inquiry. They wonder why sits the valuation dropping. Plus subsequently they conclude if this reply mirrors some shift regarding worth or some shift regarding who sits dumping plus why. Right today the reply toward this inquiry means panic dumping, panic funds, margin requests, nations settling petroleum invoices utilizing metal they might preferably retain. The worth regarding the core holdings remains totally unchanged. This trader who comprehends this disparity holds an edge which does barely persist endlessly. Exchanges run rational over the macro horizon. They run irrational over the micro horizon, exactly amidst those instances harboring extreme chaos. This remains one among these instances. 3 gateways, firstly bullion plus silver, wherein this chasm separating cost against worth sits the broadest it has stretched across this rotation, forged via panicked offloading which shares zero to share with the systemic motives to hold them. Secondly, carbon, wherein one cycle of green-driven inventory crushing sits colliding a usage bounce fueled via the highly massive power crisis across a lifetime. Thirdly, bioscience, wherein $1.2 trillion of corporate buying capacity stands hunting a funnel deficit which cannot be cured internally, plus wherein the schedule sits publicized across exclusivity death charts which every massive corporate panel has examined. I have burned 40 cycles tracking such rotations. These gateways which appear heavily like peril remain usually the avenues which forge the highly lasting riches. This progression stands in gear. If you deploy upon this plus how this remains your choice to.